Hello everyone, welcome to the lecture for Chapter 3. I want to go back and just go through part of the accounting cycle that you've already learned. We started with analyzing transactions. That's where you'll receive a source document and then the bookkeeper usually will make a decision about how that is entered into the journal. You'll journalize that transaction. Remember that the journal is a chronological listing of all that's happened in the accounting process. It's by date order. It will have a debit and a credit for every activity that's come through, sometimes more than one debit or credit to make it balance. And from there, we post it to the general ledger. Remember back when I told you back when I was young that general ledgers had a sheet, a page, and we kept track of it. Now it's all done in a computer, but every account has its own ledger page, whether it's on paper or in a computer, so that you're able to keep track of the value of each separate account. Once it's posted, everything's posted for the time period, then we did an unadjusted trial balance. You guys have moved that far to prepare an unadjusted trial balance, and you've also prepared simple financial statements. Today, what I'm going to go back and talk to you about is making those adjusting entries. When at the end of each accounting period, there are some things that have not been accounted for in the system. So as managers, you have to make decisions and calculate what those adjustments are going to be. And that's what we're going to start on today. Later in this chapter, we'll have lectures that talk about preparing the adjusted trial balance, preparing the statements, and then closing out for that time period. All right, let's get started. First of all, let's talk about the accounting period. You know that when we put headings, when we titled those financial statements, that you had to say what the time period was. Well, a normal time period is either monthly, quarterly, every 6 months, or every year. 1 year is a normal accounting period. Sometimes it's a fiscal year, and sometimes it is a calendar year. A calendar year is from January 1st to December 31st, but a fiscal year may start on June 1st and move through May 31st. Businesses usually set their time period, their accounting time period, to end after their very busy season. I don't know this for sure, but I would guess that Walmart's annual calendar ends on January 31st. That way they went through all of their seasonal sales and then all of their seasonal returns, so they have a good understanding of exactly what happens in 1 year. During universities, fiscal year is June 1st through May 31st because that's an entire school year. So they're able to see what has happened for an entire school year. And it's very important that you understand time periods. We will be working mostly monthly and annually in this one. But just understand that there are time periods and that the accounting ends on this date and starts over on the next date. So we have an ending time period, December 31st, a beginning time period on January 1st. So we have two different kinds of bases for accounting. You're going to find as we go through the semester that I'm going to talk to you some, and I'm going to say you can choose this option or this option, and then once you choose that option, there's rules that have to be followed, GAAP, generally accepted accounting principles, that have to be followed within that. So accrual basis says, this is very important, you probably want to memorize this, revenues are recognized when products or services are delivered, and expenses are recognized when incurred. So what that means is that if we earn money in December, we send a bill and they don't pay until January, we recognize that revenue in December when the service was delivered. It also means expenses are recognized when incurred. So let's say that our company received a utility bill in May. We're not going to pay it till June. We recognize that utility bill in May. We have an accounts payable. It may be paid in June, but we recognize the expense when it's incurred. That's accrual basis. Cash basis says, we recognize the cash when we receive it, and we recognize the expenses when we pay them. Well, for very small businesses, that's okay, but it's not a true accounting of what happens during the actual time period. So according to GAAP, companies are supposed to use the accrual basis of accounting. It's what's expected for publicly traded companies. It's what they have to do. For tax preparation, it is what is expected. So accrual basis is the true preferred GAAP way, although some very small companies still operate on a cash basis, and it's okay, but those are very small companies. So we will always be looking at accrual basis accounting. All right. So let's talk about accrual basis versus a cash basis, and let's give me a problem so that you can understand it. So on the accrual basis, $100 of insurance expense. Okay, so what happened here is in December 1st, 2017, we paid for 24 months of insurance, but only 1 month of that is in 2017. 12 months are in 2018, and 11 months of that insurance are in 2019. So that insurance is spread out over actually 3 calendar years. So we have to figure out a way to show that as an expense in 3 calendar years. Insurance is a prepaid expense, so it is an asset, because if we close the business, we can apply for a refund. All right, so on the accrual basis of accounting, $100 of this insurance is recognized in 2017, $1,200 is recognized in 2018, and $1,100 in 2019, because those are the periods that benefited for this insurance coverage. On December 21st, 2017, Fast Forward purchased $2,400 cash for a 24-month business insurance policy. So if we recognize this on the cash basis, all $2,400 would be charged to 2017 year, and that doesn't show an accurate accounting. So this is how you would show this as a journal entry. On 12/1/2017, we have an asset of prepaid insurance of $2,400, and we paid cash. So we credit $2,400, and the description would be purchased insurance for 24 months. Okay, that is the journal entry. We have prepaid insurance. We know we're going to use 1 month of it. So at the end of the month, you're not going to get a piece of paper that says $100 of this is expired. The management has to make those calculations. So we say on 12/31/2017, we had $100 of insurance expense. And we would reduce that prepaid insurance, that asset account, by $100. And then we would say 1 month insurance premium expired. So that gets us correct for 2017. Well, what happens at the end of 2018? Same thing, but now we've used 12 months of that. Again, insurance expense, $1,200 because it's for 12 months. Prepaid insurance, $1,200. And our description would be 12 months insurance expired. And our T account for prepaid insurance is going to be prepaid insurance. Aren't you glad I got new markers? Now you can see them on the board. And it was $2,400. And on 12/31/17, we reduced it by $100. So then this account had $2,300. The end of the next year, we reduced it by $1,200. So at the beginning of 2019, this account has $1,100 left in it. So we know that we have $1,100 of insurance to still expire. So there are some classic prepaids that we do. For instance, prepaid insurance. I'm going to go back a couple because it's revenues and expenses that we're going to look at. I just showed you an expense one. But if we go back to our principles where it talks, chapter 1 talked about the 4 principles, and one of them was revenue recognition, and it says that we recognize revenue in the period in which we earn it, not necessarily in which we receive it. And the expense says that we recognize expenses in the month that they incur, not necessarily when we pay them. So we know that we paid $2,400 in insurance in December 1st of 2017, but that's not when the insurance coverage, the whole $2,400 didn't apply to that December. 12 months applied to 2018, and then another $1,100 applied to 2019. Okay, about got my board cleaned. This is a tough board to get clean. All right, so let's look at the framework for all of these adjustments. For instance, we have 4 areas where we make these adjustments. One are prepaid expenses. Classic ones are prepaid insurance, prepaid rent. The second ones are unearned revenue. And an unearned revenue is 3 good examples I can actually give you. One is an attorney or an accountant who requires a deposit up front. They haven't earned that money, so it's a liability because you may have to give it back to them. The second one are season tickets to sporting or theater events, and you pay for the full season up front, and if for some reason they couldn't deliver a whole season, they have to pay it back to you. And the third type is magazine subscriptions. You may pay for a 2-year magazine subscriptions, and if they don't continue business, they have to return that money to you. So prepaid expenses are always an asset. Prepaid unearned revenue is always a liability. Seems backwards, but that's how it is. Accrued expenses are expenses you have accrued but not yet paid. So I use the example of a utility bill. And accrued revenue is work that you may have done for someone but they haven't yet paid you. So the framework for these adjustments is that you determine what the current account balance is. You determine what the current account's balance should equal, and you record that adjusting entry. So let's go back to our insurance example, prepaid insurance. And we know that on 12/1/17, we paid $2,400. We knew that we had used 1 month up at the end of the year. It had expired. So we knew that our balance should be $2,300 now. So we reduce it by $100. So this is the whole basis of the framework for adjustments. So in class on Monday, I'm going to start going through with you these different types of accounts and the different framework for adjustments. And make sure you've read the pages you're supposed to read, and I will see you in class on Monday. Thank you.